All right, class, I just want to quickly go over your exam with you just to give you guys an idea. So just if you can pull up your exam, it should be graded. You should have your um, grades there for you, and I will be updating your midterm grades now that I have some stuff. So, question one: Ford Company wants to issue bonds with the following information: $400,000 bond for 5 years at a rate of 3%. With uncertain markets, they would like to show you the entries for issuance at face 97 and 102. Prepare the issuance and one interest entry for each of the situations for the total of 6 entries. They pay interest semi-annually twice a year. In other words, semi-annually. Now, one thing I want to mention to you guys. Now, some of you guys did really well, and some of you guys did very poorly. Some of you guys didn't even do it at all. The thing that I want to mention, and I'm going to tell you this right now from the get-go, when you're taking an exam of mine, it's very important for you to pay attention to detail. Read the instructions. Listen to what it's asking you for. Okay? Some of you guys did all the issuance entries, and then you did not a single interest entry. Okay? It was disheartening because you guys really did not pay attention. Some of you did not pay attention to your rules when it came down to your bonds and stuff like that. And that's quite hard and difficult for me when we spent that much time doing it. So, going back to the entries here. The first one, if we're issuing it at face value, you would be debiting cash for $400 and crediting bonds payable for $400. The next one, if you were doing the 97, which is a discount, which means your cash received is going to be less than the face value. But you got to keep in mind, again, rule number one, the bonds payable will always be the same. So you know your credit to bonds payable is going to be $400,000. If you take 400 times 0.97, that would have given you cash debit for $388 and a bond discount debit for $12,000. And again, 388 plus 12 equals 400, and 400 equals 400, so your journal entry continues to stay in balance. So you'd have cash debit, bond discount debit, bond payable credit, and it would be 388, 12,000, 400,000 respectively. Moving on to the next one, the 102, meaning a premium. That means the amount of cash that you're going to receive was going to be more than. So you would debit cash, and in this case, it would have been for 408. Your first credit would be for bonds payable of 400, and then your journal entry, or the other part of your journal entry, would be a credit because you're short on that side for 8,000. So you would have cash debit 408, bonds payable and credit for 400, and bond premium 8,000 for a credit. Now is when you need to do your journal entry for your interest entry. Now, the first entry is the easiest because all you need to do is know your formula, P times R times T. So some of you guys didn't do the T factor. So the P times the R, 400 times 3%. That would give you 12,000. And then your time factor is 2 times a year, or 6 over 12. So 12,000 times a half would have been 6. So your first entry for interest under face value would have been interest expense 6,000, cash credit for 6,000. You're paying somebody interest, so that means your cash is going down. If you were to do the one for the bond discount, this is where your rule number 2 comes in. And rule number 2 said that cash will always be the same. So you know that you're going to be crediting cash for 6,000. Write it down. You know that your interest expense is going to be a debit. Don't worry about the amount. Just write down interest expense. And then the last thing you're doing is you're amortizing your bond discount. So you're going to get rid of the debits that we have done at the first one, it means we have to credit it. So we're going to credit bonds discount. Now, forget about even the amount yet. I'm just going to go through the accounts that you should have. You should have cash debit set up, interest expense debit, cash credit, and bonds discount as a credit. You should have 6,000 written for cash because rule number 1 says that's not going to change. So then your next step would have been taking the number of years, which in this case was 5, and we're paying 2 times a year. So the number of payments is going to be 5 times 2 is 10. Divide the 12,000 by 10, and that would give you $1,200 a year. That is the amount of your credit for bond discount. So you'd have $1,200 as your bond discount credit, and then you have cash as a $6,000 credit, and that means you can come up with your debit, which would have been $7,200 for interest expense. Now, if you move on with the same logic to your premium, you got interest expense debit. Your bond premium was a credit in the issuance, which means it's going to be a debit in the interest. And cash is going to be a credit. Cash's amount is going to be $6,000, so write that in. And the number of payments is 10, so you would take the bond premium of $8,000 divide by 10, which gives you $800. So you're going to debit bond premium for $800, and then just 2 or 3 numbers, you should have figured that out, and your interest expense would have been $5,200. Now, I want to point out that each one of the journal entries is worth 5 points. So that first question is worth 30 points on your exam. Okay. Question 2, prepare the payoff or maturity date entry for the information used in question 1. That's an easy 5 points because that's just simply bonds payable as a debit and cash as a credit for the amount of $400,000. Number 3, as promised, what is the bond indenture? One word answer was fine, and the bond indenture is a contract. Number 4, what's the one word used to describe a secured bond? You could have used the word collateral. That would be fine. Number 5, there was 3 journal entries that I asked you to prepare here. And again, I know during the slide, I told you, do not worry about the reorganization or organizational one. Just worry about the other ones. Okay? So the first thing here is they're selling 25,000 shares of common stock. Now, they sold 25,000 shares for $4, and the stock had no par stated. So the cash, obviously you're selling common stock to get cash. So cash would be debited for 100, and in this case, it had no par stated, which means the exact same amount, 100,000, would have been a credit to common stock. So letter A would have been cash 100,000 debit, common stock $100,000 credit. Letter B, they sold 25,000 shares for $4 a piece, and the stock had a par value of $2 a share. So in this case, it would have been a debit to cash for 100,000. A credit to common stock for 50,000 because par value times 25,000 shares. And then the additional money that was left over, you still need a $50,000 credit, would have been a credit to the account that we set up, APIC, additional paid in capital, dash common stock. So you'd have 100,000 cash, common stock 50, APIC 50, both credits. Letter C, they sold 25,000 shares for $4. Well, they sold that amount, so that means the cash is still going to be 100,000. The stock had no par, but it had a stated value of $3. Well, I told you in the lectures, stated is the same as par, and par is the same as stated. So in this case, it would have been a $100,000 debit to cash, and it would have been a $75,000 credit to common stock, and a $25,000 credit to additional paid in capital. Okay? Again, everything's in your slides. It's been in the lectures. I had a couple Zoom meetings, and I had just a couple people show up for them. So again, please ask. If you have questions, ask. How does a company figure out what the par value of a stock is? They don't. It's a made-up number. It's arbitrary. And that's right in your slides. The sad part is I can't stop you guys from looking at slides when you're taking an exam. So when you're taking this exam, if you've got your slides there, I don't see why you guys didn't do better on some of these. Number 7, there are 3 key dates for a company paying a dividend. Please list the 3 dates and give 1 sentence explanation in your own words to why that date is important. Well, it's great that you guys all understood DEC, REC, and payment. But if you don't give me that 1 sentence, you're not getting full credit for the question. Again, it's something that's right there in your notes. I gave you examples, and it's not like it's just, Wall Street companies that do it. I gave you a local company that does it. I've given you all that information for you to work with. Okay? Next one, number 8. Who's responsible for the election of the board of directors of a corporation? That's in those 3 boxes at the very beginning of chapter 11. That would have been the common stockholders. What is one job of common stockholders? To vote, to invest their capital. Number 10, who's paid first in terms of a company when paying a dividend between the types of stocks that we have spoken about? Well, we only spoke about preferred, common, and treasury. Treasury doesn't get paid a dividend. Common stock and preferred do. Well, which one gets paid first? Well, the people that are preferred. So preferred stock. If you owned preferred stock, which type would you prefer to own out of the 2 that I mentioned? Well, there was only 2 that we mentioned. It was cumulative and non-cumulative. Well, if you're buying preferred stock, you always want to try to get cumulative preferred, because if they don't pay a dividend this quarter, they owe you that money in a cumulative. It adds up. That's what accumulating means. It adds up. Non-cumulating means if they didn't pay you, then you're SOL, shit out of luck. So if you had to own that, you would own cumulative preferred. Number 12, where on the stockholders' equity section would you find treasury stock? What is special about it? Well, it's located on the very bottom of your stockholders' equity section, and it is a contra equity account, which means it's deducted or has the opposite balance. Hence the reason why at the very bottom of that slide it says less treasury stock. Number 13 is a dividend question. Using the following information, please prepare the journal entries for a cash dividend. Molly Corp has decided to declare a 20-cent dividend on January 1st. Well, that's your declaration date. The record date is February 1st with a payment date of March 1st. At the time, now again, at the very bottom of your dividend slides, it tells you dividends are only paid on outstanding shares. So you needed to do your T chart, your tree diagram, to figure out how many shares are outstanding. I didn't give it to you. You had to figure that out. And I even wrote, note, remember, we only pay dividends on outstanding shares. So if you had set up your tree diagram, you would know that 500 was at the top. If unissued was 25,000, that meant there was 475 issued. And then issued breaks up into treasury and outstanding. So 475 and treasury was 75. That meant there was 400,000 shares that were outstanding. So then all you needed to do there was 400,000 times the 20 cents, which would have given you a dividend of $80,000. And then it was simple from there. Your declaration date is dividends and dividends payable, 80,000 in each one. Your record date, you would have wrote no entry. And then your payment date is dividends payable debit, and then cash credit for the same amount, 80,000. The biggest thing here was you needed to find the number of outstanding shares, which some of you guys just disregard or don't listen to the lectures well, and that's going to kill you. Moving on to number 14. 14 talks about COVID Inc. has decided to purchase some of its own common stock back off the market. Well, if they're buying their own stock, that's the definition of treasury stock. Using the following information, please prepare the journal entries as required below. If you purchase something, that means your cash is going which way? And if you answer that question on your own, cash is going down. Well, cash is going to go down, and in this case, treasury stock is going up. So they purchased 2,500 shares at $6. Well, 2,500 times 6 would have given you a debit to treasury stock for $15,000 and a credit to cash for $15,000 also. Letter B, sold. If you sold something, that means you're receiving cash. Okay, you're receiving cash. Cash is going up. So cash would have been a debit. And then in this case, you're selling treasury stock. So treasury stock is going to be going down. And treasury stock goes down with a credit. Now the key here is you sold 1,000 shares at $9. So you're getting $9,000 cash. That's your debit. When you figure out your treasury stock, I told you, you have to go back to the original amount that you paid for it. So here we're selling 1,000 shares, and what did we pay per share? We paid $6 a share. So 1,000 times 6 would give you a credit to treasury stock for 6,000. So now you should have 9,000 and 6,000, 9 on the credit, 9 on the debit, 6 on the credit, and you need another $3,000 credit. And then we spoke about the additional paid-in capital account for the extra 3 credit. The third one, letter C, it says sold 500 shares of treasury stock for $4. So your cash is going to be going up. 500 times 4 is $2,000. Treasury stock is a credit. You're going to take the number of shares times your original purchase price. So 500 times 6 would have given you 3,000 as a credit. And then your journal entry doesn't balance because you got 2 on the debit and 3 on the credit, which means you need $1,000 debit. And again, that would be using additional paid-in capital. Or if you were following your notes, you would have probably written retained earnings, which nobody did. But if you had done that, I would have accepted that also. Then it says letter D, sold 500 shares of treasury stock at $6. Well, cash going up by 3,000 because that's 500 times 6. And then again, you go back to the original amount that you paid for it, 500 times 6. It just so happens it was the same amount. So if you're selling it for exactly what you paid for it, you don't need the additional paid-in capital. So this would have been a debit to cash and a credit to treasury stock for $3,000. The last question in this one, letter E, it says how many shares of treasury stock are still left, still being held? Well, you originally bought 2,500 and you sold 2,000. So if you started with $2,500 and you went shopping and spent $2,000, you still have 500 left. So in this case, you still have 500 shares left of treasury stock. And then question 15 was the simple one, which was just, what is treasury stock? Treasury stock is when a company buys its own stock back. Okay? So some things I just want to point out to you is, number one, this course is not going to get any easier in chapter 14. That's our hardest topic, and that's coming up next. And I really need you guys to pay attention to detail, okay? Even when it comes to your ratios, I'm going to be going through tonight and doing the ratio homework and grading that and getting it back to you because we are going to have our exam coming up here over the weekend. So I need you guys to start paying attention to details. Details. Read your questions. Pay close attention to everything, okay, guys? So I wanted to give you this video to go over your exam so that you understand. It would be exactly what I would do if we were in class. I would go over your exam with you. So I wanted you to listen to the video, go over the answers with you so that you have an idea. And you can take back and look and see what you have and have not done right or wrong. All right, so I'm going to go ahead and I'm going to put that up and move on to the next topic.